The new journey will be chapter 5, which is a job order costing. Why do we need to do the job ordering costing? Obviously, for many reasons, but the obvious reason is because we open our company. And most likely our objective is to generate profit. Now, it will be very hard to generate profit if we don't know what the cost for our product is. So for that reason, first we have to calculate the cost of the product which we're planning to sell. Now, if you're selling services, that's a different story. So technically, if you open your business the way I see it, you have three options. Either you have to go with the service, either you have to go to merchandising business, or you have to go to manufacturing businesses. In merchandising business, if you go with that type of business, either you're going to be wholesale, you're going to be retailer. And that's pretty much cover all the options in general of what kind of services you can, or what kind of businesses you can have available. So in all those businesses, in order to be successful, again, you have to generate operating income. Now, the source of gross income comes from only one place, from the customers. If you don't have customers, then it will be very hard to generate income. So those customers going to look for something. Either going to be services, going to be merchandising, or going to be finished product. You need to know the cost of either your service, either your product, either your inventory, merchandising inventory, either your product, which is the finished goods. In order to do that, you have to calculate the cost. So once you cover the sales, you cover the cost of the service or the product or the merchandises, then you're going to generate gross margin. With that gross margin, you have to cover the operating expenses. That brings us to the traditional income statement. When we have a sales, if you can picture it in your head, we're going to have top sales, then you're going to have cost of goods sold. Then we're going to have a gross margin. After that, we're going to have operating expenses, which are involved with running the business. It's going to be marketing, it's going to be advertising, it's going to be administrative expenses. And then we're going to have, if there's anything left, that will be our operating income. And now from operating income, you can enjoy it and get something if you have a cash. That's the general picture of the business. So what you need to know, obviously you need to know the cost of your goods that you're selling, or your products that you're selling, or your services that you provide. Otherwise, you won't be able to generate gross margin. If you don't generate gross margin, there's nobody to cover the operating expenses, so you're going to lose money. Last week, what we did is we did the different classification. We went to the cost volume profit analysis, and we were working on the different calculation in terms of how the costs behave, and we divided by the variable and fixed. In today, we're going to go back to the first classification, the very first, if you remember, how the costs are assigned to the object. And now there will be direct and indirect, one of this, and how the costs are reported to the financial statements. One cost we said is a product cost or inventoriable cost, the one that stays on the balance sheet as long as we carry the product in our warehouse. Once the product is sold, it becomes cost of goods sold. The other cost is the period cost, which is directly expensed during the period, indirectly in the operating income. Now, how are we going to get the cost of our product? There are two systems that can help us. One of them is if we producing a single product, which is continuous product. Now pay attention, this is chapter 6. And this will be all from chapter 6 that I want you to know. Process costing is chapter 6. What that means? One of the costing system is process costing. The other one is the job order costing, which we're going to talk today. Process costing, I'm still going to talk, but one of the slides is this. Which company we're going to use process costing? First, it has to be a company that produces many units of a single product. So we have one product which is one just over and 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 over again and over again and keep going and keep going and keep going and keep going. For example, let's be Astro Vulcan and let's Astro what probably Astro will be the company and we producing yogurt. One option is to produce the plain Astro yogurt, and we start producing 2% yogurt. Once we get tired of producing 2%, we're gonna flip and we're gonna start producing bananas flavor. And we're gonna start producing banana flavor until we get tired, and then we're gonna switch to the cherry flavor. And we're gonna keep going and keep going, keep going until we get tired. Then we produce one with cappuccino flavor they have. And we keep going, keep going, keep going. The other flavor they have is strawberry flavor. So there's so many flavors available. But again, I'm doing a single product. So when my client comes, he can choose from the left or the right or the top or the bottom, but that will be exactly the same product. So one unit of the product will be indistinguishable from the other product. Why? Because it's the same color, the same package, the same weight, the same cover, everything is the same and the same price. Now, the identical nature of each unit of product, that will give us opportunity to find the cost in a very simple way. What will be that? We're going to assign the average cost per unit. How are we going to get that average cost? We're going to get the total cost for the period. We're going to find how many units we produce over the same period. We're going to divide the cost on the units, and we come up with the average cost per unit. This is your chapter 6. That's all I want you to know. That the process costing exists. It's for the company that producing many products of many units of a single product. One unit of the product is distinguishable, and the cost per unit is assigned by the average cost based on the total cost for the period divided by the number of units produced for the same period. That's it. That's your chapter 6. How much will be examined about this? This is the only thing that's gonna, no, not now, just a little bit later, I'm gonna show you how much we're gonna be examining. Let's go now with the type of with the process costing. Example will be this cement mixing company, Mary Cements, which producing cement, bags of cement, and producing, or Petro-Canada, refining oil, or Coca-Cola. And they're gonna produce the Coca-Cola. So now when you go to the store and decide which bottle of Coca-Cola to pick, how do you choose which one to pick? You just go and grab one. Or you're chasing which one has some more content. Well, guess what? Now, most likely the content is controlled by artificial intelligence. So the chances you to get a little bit more liquid that will be 0.01 milligrams more than the other one is very, very, very slim. So if you don't like Coca-Cola, then you can switch to Fanta, but that will be the same product. Then you can switch to Sprite, which will be the same product, or you can switch to, I believe, tonic, which will be exactly the same. That's a process costing. Now let's see the job order costing. Job order costing, in the job order costing, we will produce many different products, which each product will produce at each period. Product is manufactured only and only when the customer comes and orders it. So what's the difference between the process costing and job order costing? Imagine I am a bakery and I'm producing cakes. One option is to produce cheesecakes. But now I'm producing the cheesecakes for, let's say, Safeway and Safe on Foods. Those are my customers. So what I'm going to produce? I'm going to produce one cake or I'm going to produce thousands? better be thousands. Otherwise, they're not gonna keep me as a company who's they're buying the products. So I'm just producing the same product over and over and over again. I'm gonna start with the plain cheesecake. When I get started, I'm gonna add some blueberry flavor and some chemicals that taste like a blueberry. Mix it on the top. There you go, blueberry, and I'm gonna produce another 1,000. And then I get gonna go to the strawberry. Same idea. Put strawberry down. That's one option. The other option is I'm a bakery, but I'm again producing cakes. But now I'm doing cakes which are custom cakes. The client comes and say, "Can I order a birthday cake for my son?" And he's a Lionel Messi's fan. I want the soccer ball to be the cake to be with the shape of the soccer field, soccer ball in the middle with the colors of the FIFA World Cup colors for 2026. Plus Lionel Messi's picture on one side of the soccer field, and on the other side of the soccer field, I want to be his parents, picture of the parents or my son all together. And I want to be inside to have one layer of mango and one layer of strawberry, plus cream and vanilla cream and some other cream. Now, as you can see, we're talking about a super specific product, which is ordered by the customer. So for that particular product, we have to go with the job costing. Why? Because the product will be manufactured only and only when it's ordered. Now, the unique nature of that particular cake that we have to do, it requires us to trace the cost to each job and maintaining that cost record for each job. So that's order costing. So now let's see which company using the job order costing. That most likely will be Bombardier when they're producing the aircraft or they're producing the trains for the cities, mostly in Europe and now in Canada. It can be Becher International, which is the large-scale construction company, which again dealing with the different customers, which have a different requirements for every construction job. And Hallmark will be the example which want different greeting cards for different purposes. As you can see, completely different products. So in summary, the two costing processes the two processes that we have: process costing, job order costing. In the process costing, we're going to produce a single product. Costs will be accumulated by department, and average cost will be computed by department as total cost divided by the total units produced. End of the story. That's your process costing. Now let's see job order costing. Job order costing, the number of the jobs that we're going to work will be many. It's not like a single product, so many different cakes. Cost will be accumulated per job or per order. Average cost, again, will be computed for single order or per job. And now the test on chapter 6. That was a summary of chapter 6 and chapter 5. Now the test on chapter 6. Which of the following company will be likely to use a job order costing rather than process costing? Now let's see. Scott Paper Company. What kind of costing system they're going to use? Job order or process costing? Obviously, process costing. Why? Because they're producing the same clinics, so we can wipe our tears when we get hurt. Architects. Job. Why? Because different people want different things. It's not like we doing a conveyor and running the same design over and over and over again. Hence, and that's related to the ketchup. specifically. Process costing, right? We just produce it. Ketchup, 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 ketchup. When we get tired, we're gonna put some flavor, spice or something like different, and we're gonna call it like a what would be that? Hot ketchup, and we still keep going, keep going, keep going. Caterer for wedding reception. All right, job costing. Okay, how about builder of commercial fishing vessels? Job costing, not process, correct? Because it will be very hard for us to build 1,000 commercial fishing vessels. Just to put it on conveyor and start building those vessels. That will be hard thing. If we're making drones, that's a different story. In the drones, if we're making drones, what kind of system we're going to use? Job order costing system or process costing? Most likely process. Why? Because once we start manufacturing, we just keep going manufacturing, right? All right. And you're right. That was your test on chapter 6. Chapter 6 gone. Now let's focus on chapter 5 because chapter 5 is going to come on the midterm exam. Is that solve the problem with chapter 6 and how much of the chapter 6 is examinable? Great. Are you happy with the content on chapter 6 that's going to be examinable this semester? All right. Then let's keep going. If we have happy students, let's keep going. Don't forget, we're in the managerial accounting. The most important thing for us is to keep the customers happy. Once we keep the customer happy, everything is great. Now let me sell you the costing system, which is called job order costing. So in the job order costing system, the whole idea is we to come up with the cost of the product. Because if I cannot come up with the cost of the product, I won't be able to find the selling price, which guarantee me a gross margin, which gross margin later have to cover my operating expenses. Because if the gross margin doesn't cover my operating expenses, then I'm not going to generate operating income. So, example, let's go with example. Let's open a coffee shop. Direct material, I can easily trace it. Direct material will be my coffee, my milk if I have to use for latte cappuccino. That's strictly identifiable, direct cost, nothing scary there. Direct labor. I can easily get my hours or hours of the person who's doing the coffee. That's called barista. So the barista, we're gonna get the hours for barista. Because the name is fancy, we're not going to give a minimum wage 18.25 is the minimum wage since Monday, isn't it? Monday was an important day in BC economy. Do you know what's the next important day? No, it's not 25. It's 18.75. So the minimum wage increase. Let's see. Let's see what's happened with the minimum wage. Let me share my screen. Quickly, let's go. Let's make a little jump on the minimum wage and see where is the direct labor now in BC. Minimum wage in BC. Current rate is 18.25, effective June 1st, 2026. Increase with 40%, with 40 cents, sorry, 40 cents or just over 2.1% from the previous 17.85. So you have 40 cents increase. Now, what's the minimum livable rate, not livable rate in let's go Burnaby or Vancouver. That's a different story. The minimum livable rate in Vancouver is 27.85. So there's a slight discrepancy between the minimum, official minimum wage and the livable rate in Vancouver. But that's a very, very minor difference. So let's go now with our slides. And okay, I can easily calculate the rate for my direct labor. That was the point, we to calculate the rate of our direct labor. Now, if you still remember, the product cost has three costs. The product has three costs. It has direct material, it has direct labor, and it has manufacturing overhead. At this point, I can calculate two of them, direct material, direct labor. So again, our coffee shop. Direct material, what will be direct material? Direct material will be the coffee. I can easily calculate if I have to make, if the customer asks for cappuccino, how much coffee I have to use. If the customer asks for latte, how much coffee I have to use. If the customer asks for simple espresso, I know how much I have to use, so I can come up with the cost of direct labor. I can easily calculate that one. I'm going to time myself how much takes me from the order the customer till the customer receive his order, how much going to take me some minutes or to prepare the product, time my annual wage, hourly wage. I can easily calculate my direct labor. The third component is the manufacturing overhead. And what's going to be in manufacturing overhead? That's the question. Now, the manufacturing overhead, we're going to have indirect cost, right? Direct cost, we have direct material, direct labor. Manufacturing overhead, we're going to have this indirect cost. The indirect material, indirect labor, indirect material will be the cleaning people, the security people, some other people which might be involved in our operation, coffee shop. Indirect material will be some straws that we're gonna provide with our coffee or our product. The cup, we're not gonna be like a Starbucks to charge 25 cents for the paper cup. That's cheap, right? We're not gonna be Starbucks in this case. We're not gonna charge for the straw either. We're not going to charge for some other napkins and anything like that. We just once the person buy the coffee, that's it, nothing else. We're not going to keep it that complicated. The other thing is in the manufacturing overhead, we may have some other costs which are not that easily traced or identifies like a securities, like a insurance, like a rent, like a property taxes, like a utility cost, and all those different costs. Cost. Now the question is how we can calculate those costs. Now, in order to calculate those costs, I'm going to stop right here. And let's go to another place, which is called Excel spreadsheet, and start doing our company and chasing the cost in our company on Excel spreadsheet and see how this is going to go. So obviously we are the manufacturing company. In the manufacturing company, as you already know, we have three inventory accounts. One inventory account is called raw material. The other inventory account is called work in process. And the third inventory account is called finished goods. Why do we need all those accounts? Because from the finished goods accounts, we're going to get our cost of goods sold. So let's put some name on our accounts here. so we can see which one is what and how we're going to deal with those. First one is the raw material. Second one will be work in process. That's not recipes, that's a work in process. And the last one is the finished goods. So we have all the three accounts, which is going to help us to calculate the cost of goods sold. Why do I need the cost of goods sold? Because the cost of goods sold I needed to when I prepare my income statement. And more specifically, I need my sales. Then I need to find the cost of goods sold. Then I can calculate my gross margin. Once I get the gross margin, then I have to deduct the operating expenses, and that's going to give me the operating income. And that's what I'm chasing. That's why we started the business, to generate operating income. Now, I won't be able to calculate my operating income if I don't have my cost of goods sold, correct? And once I get my cost of goods sold, the next thing that I need is my operating expenses. Once I have those two as expenses, then I have to make sure that the sales that I'm generating selling my products cover those cost of goods sold plus the operating expenses. Otherwise, I'm never going to see any positive number here. So we need to find the cost of goods sold, which cost of goods sold, as you can see, coming from this account, which is called finished goods. Only from the finished goods we can get this cost of goods sold. So we get the cost of goods sold. Now, but from the finished, before they become a finished good, since we're a manufacturing company, we have to produce them. In order to produce them, we need to have a cost of good manufacturing. And if we have a cost of good manufacture, once the product is ready, we're gonna move it to the finished goods. And those cost of good manufacture is gonna move from the working process into the finished goods. That's the idea. That's what we're chasing. Now, let's go to our coffee shop and let's start our process for making coffee. First thing first, let's get the direct material. So I need here direct material. I need direct labor. I need manufacturing overhead. If I don't have those three, I can never sell my coffee. All right, the customer comes and say, can I have a coffee? Let's say we pretend we just opened the business. It's January 1st, 6 o'clock in the morning. We open the door of our new created business, which is called Coffee for Everyone in the morning, just to make it more specific, personalized. And or we can go with something else. Do you know what's very very interesting for me that I'm seeing? If you're selling water and if you label it water, that's boring, right? But if you call it smart water, suddenly the customers start buying. I don't know why there's so much buying smart water. Is that because they're not smart, or then they don't see itself or each other smart, and they actually believe when they drink this water is going to become smart? Rather than study. I don't know, but the name of the product is very catchy. So if we want to sell something and get more customers, we have to find some name which people associate itself with that name, so we can get more customers. So in our case, we're gonna sell super intelligent coffee for everyone, right? And most likely we have a lot of customers. So intelligent coffee for everyone. That will be our, the name of our business. So let's start now with making that. Let's make start our coffee shop. So we open again January 6th at 6 o'clock. Sorry, January 1st, 6 o'clock in the morning. Why? Because we want to catch all those people who party all night on the New Year's Eve and they're going home. But before to go home, they need some refreshment so they can make the rest of the way to their home by coming to our shop, become super intelligent, and then keep going. So the first customer comes and asks us, how much is for coffee? I want coffee. What kind of coffee you want? Let's say I want Americano. Okay, great. How much? And now we have to start calculation. Okay, we have to charge something for the materials that we use. Material used. What we're gonna have? We're gonna have, obviously, we're gonna have coffee. We're gonna use coffee. And that will be our direct material. Direct material, we can easily calculate how many pieces of coffee we're using and how much milligrams or grams or pounds of coffee we need to produce one single coffee, and that's going to give us our direct material done. Super easy. Then we're going to have some indirect material. What will be the indirect material? Maybe we should use some water here, some what will be that straw that we have to provide. We're going to put it in the nice paper cup, which we're not going to charge the client again. But that will be another cost that will be related to our coffee. There will be that cup is going to have a lid, which lid is unique size, which doesn't match Starbucks or Tim Hortons or McDonald's. So you can put our lid only on our cup, not on any other cup, because we are using strategy which is value leadership. So it's completely separated from all the other brands, and we want to establish our own brand. So all those will be indirect material. What we're going to do with them? Very simple. For in the beginning, we're going to start. We're going to open this account, which is called manufacturing overhead account. And we're going to start accumulating the cost in this account during the period. So we're going to start using once we use the materials, we're going to call it some of the material, direct material to calculate the cost. Some of the material will be indirect, and we're going to put it in this indirect material account. How we're going to do this? I'm going to use this interesting kind of tool. Let's see, that's not going to happen again. It has to be a little bit bigger in order to catch it. Otherwise, it's not going to catch it, but I can leave it like this. So this one comes here, and that's what provides me my indirect material. So I got my indirect material from the material that I'm using. No, actually I need it the other way. Let's make it bigger. That should do it for me. So that's how I get my indirect material, and indirect material gonna make it indirect. Okay, great. I have the material. So I can calculate the cost of my coffee. The next thing that I have to calculate for my customer is the labor. The labor, I'm gonna calculate how much, how many hours I sell, how many minutes I work on the coffee, and I'm gonna use the payable account. And which one side will be debit and the other side will be credit. Since it's the liability account, the normal balance will be credit, but that's not the objective here. The objective is we to get our cost of our coffee. So we're going to get our direct material and we're going to allocate it. How are we going to allocate it? Again, I'm going to insert one of those fancy shapes, which is going to look like this. And from here is going to go the opposite direction now. Let me see if I can flip it the opposite way. Not this way, not this way. It has to go like this. And I have now my direct labor. Boom, right there. My direct labor just came. And I calculate my direct labor. Obviously, if I have direct labor, there will be some indirect labor as well associated, which will be for the security people, for the cleaning people, for, I don't know, for some other people which are going to work in our show. They have to be other people, right? So those people, they're going to give me my indirect labor. They're great. Now, what I have? I have the direct material, I have direct labor. I don't have manufacturing overhead, right? If I don't have the manufacturing overhead, I cannot sell my product because I don't have the total cost of my product. If I don't have a total cost of my product, I cannot price my product because I don't know how much will be my cost of good manufacturing, the cost of goods sold, and operating expenses. There's no way to know them. So the question is, how can I sell my product if I don't know my manufacturing overhead? So we're thinking, and what we're going to say to the customer, you know what? You're good that you ask for the coffee. It's good that you ask, do you want to pay for the coffee? But we can easily calculate direct material, direct labor. Manufacturing overhead gives us a lot of trouble. Why? Because first, manufacturing overhead comes in different time of the year. And he's going to say, how is that? Well, the electricity that I'm going to use today to make your coffee, the bill is going to come after 2 months. The insurance that I'm paying for this store is on the annual basis. So I have to calculate for the entire year and divide by the number of the products that I'm going to produce in order to get the cost of the portion of the insurance for each product. The property taxes that I have to pay for my store, it's going to come in June, which I have to pay by the end of June, which will be another cost, but we better stay for the end of the year, then we can get the total cost. The internet and what will be the telephone bill is going to come later. Plus security, I'm paying security every 3 months, which the bill is gonna, it's already came in January, but it's for 3 months, not for January, March, February, March. So in order to calculate for your coffee, again, better get the total cost for the entire year divided by the number of the units, and that's going to give me an idea how much I have to charge for your coffee. So because of this complexity of the manufacturing overhead, you know what? Take the coffee and come on December 31st when I have all the costs from everywhere, and then you can pay me. Then I can calculate manufacturing overhead, and then you can pay me for the coffee. Can we say that to the customer? And what's going to happen to the customer if we tell him this? What do you think? Free coffee, definitely, for the customer. Is he going to come on December 31st to pay for the coffee? No, but there will be second customer come. And what? We're going to calculate direct material, direct labor, but because we cannot calculate manufacturing overhead. So what are we going to do? Not charge him for the coffee again? How many coffees we can sell like that? So now the question is, since I don't know, and I need this manufacturing overhead cost. Trust me, I need it. Manufacturing overhead cost, I need it. Otherwise, won't be able to calculate anything. I cannot calculate the cost of my product. So what do I need? I need cost on the one side. I'm going to calculate and some markup. How am I going to get the markup? Yes, I can charge him some markup. How am I going to get it? That's the key here. How are we going to get this manufacturer overhead? Can we charge him manufacturer overhead? My mother suggesting to do some markup. Based on what? Based on what we want? Do you think what that will be? We have to, okay, so there's an interesting proposal here. We have to estimate the overhead. Okay, that sounds interesting. How can we estimate it? That's the key here. Why? Because our overhead, manufacturing overhead, is going to start coming from different account. Now, if we have to open manufacturing overhead account, that overhead account again is going to have on the left side will be debit, on the right side will be credit, no questions about it. And on one side, on the debit side, we're going to start accumulating the actual cost, which we're paying during the period. And once we have indirect material, indirect labor, then we're going to start adding more costs, which will come from different accounts, which will be accounts payable, not payable, some other accounts payable. And from those accounts, we can see the insurance, we can see security, we can see utilities, we can see rent, we can see taxes, and all the other interesting things that we have to pay, which is part of running a business and part of manufacturing overhead. So now the question is how I can get these costs and how can I charge this manufacturing overhead. So again, let's say with Jamali proposal, we have to estimate the overhead. Sounds interesting. How are we going to do that? Very simple. Let me put some arrows so you can see here all these different costs that coming from this accounts payable. Okay. Now we have our graph with some manufacturing overhead cost. So now we have to come up with the estimation in order to allocate manufacturing overhead. How are we going to do this? Very simple. We're going to estimate the total cost for the whole period. Now that period most likely will be the entire year, most likely. Once we get the total cost for the entire period, that will be our nominator. Now I need denominator. Now for denominator, we're going to choose something which appears not only in our coffee, but in all the products that we're selling, which is going to help us to allocate that manufacturing overhead. The usual, and we're going to call this whatever we're choosing to allocate our manufacturing overhead, obviously is going to be called allocation base. In reality, the usual allocation base is direct labor. Why? Because most likely direct labor will appear on all of the products. Now, what's going to happen when the artificial intelligence come in place? Then we're going to call it not direct labor because direct labor will be related to the humans. That will be direct intelligence. Token cost. There you go. We have Tony, which help us. Thank you, Tony. Token cost. So we're going to have to estimate the total. Now the token cost will be nominator. Now we need the usage. How much we're using artificial intelligence to generate the product, right? That will be what how to apply the manufacturing overhead. So we have to have the element of artificial intelligence in every product. And then we're going to start with the usage of that, how much we use that artificial intelligence. Now, most likely, again, we're going to come with the dimension per hour. So we end up with the same thing. So, but the idea is we to have some uh, allocation base which is not related to dollar. So we can come up with the cost for that allocation base. So we're going to estimate total usage of the allocation base. Again, at this level, most likely the allocation base will be direct labor. Why? Because direct labor right now appears on everything, all the products. And we can easily allocate the manufacturing overhead because that's what we want. We want to allocate manufacturing overhead. We don't want our cost only to be direct material, direct labor. We want to have manufacturing overhead because manufacturing overhead is going to catch all the other costs that we have in our business, which are related to our products, which we want to transfer to the cost of goods manufactured, which we want later to go to the cost of goods sold, and we want for those goods sold to be paid by the customer as a sales price, which we're going to give us our gross margin. So can I sell my product without allocating all those costs which are indirect costs related to my product? Probably not, because if I don't include the cost of goods sold, then what's going to happen? Somebody has to pay. They're going to go with operating expenses, but the operating expenses cover for the gross margin. If I don't generate enough gross margin, I'm never going to see operating income. So for that reason, I want to be precise in my estimations as much as possible. Once I do my estimation, I'm going to come up magically with a number which is called predetermined, predetermined because we determined it before the reporting period, predetermined manufacturing overhead rate. So it's going to be predetermined manufacturing overhead, predetermined manufacturing overhead rate. Let's go only with P. Determine. That's going to disappear predetermined manufacturing overhead rate. And that's how we're going to leave it. Now, every time when we actually using allocation base, so the actual usage of allocation base time the predetermined manufacturing overhead rate is going to give us the manufacturing overhead that we're going to apply to our product. So now I can calculate this manufacturing overhead, which is on the level of applied, and I can charge it to my product. Now I can sell my coffee. So once I sell my coffee, let's insert this shape here. Once I sell my coffee, then it's easy for me because now I can generate sales, which I make sure that cover my, now I can apply among the, once I have the cost of my product, I can apply the markup 30% that we want, and we can start making some progress in respect of operating income. Make sense? Because if I don't have manufacturing overhead, even if I apply 30% markup on direct material, direct labor, what will guarantee me that markup is going to cover all these costs that I have during the period, plus operating expenses, and give me the operating income. But now when I transfer all these costs to the client as a manufacturing overhead cost, move it to the cost of goods manufactured into the finished goods, and then transfer the cost of goods sold on the income statement and make sure that I charge the customer, then I can generate gross margin, which will have to be high enough to cover my operating expenses. One thing that I want you to understand, if you don't include all indirect costs which are related to your product or services into manufacturing overhead, you'll never be able to charge it to the product. Then it's not going to be part of the finished goods that you're selling. It's not going to be part of the cost of goods sold, and you're not going to be charged to the client. However, you still have to pay it. From where you're going to pay it? From your gross margin. In that case, you better generate enough gross margin. 30% is not going to be enough for you to cover your cost, which you forgot to include it as a cost of goods sold, charge it to your client, get the customer to pay for it, and generate operating income. Everything that you forget, you have to pay it from your pocket. So you have options. The way I see it, you have options. Either you're going to charge the client and make the client pay for that cost. Either you have to pay it from your pocket, away from your gross margin. Make sure you have a big pocket. Now, in reality, is it possible you to forget to put or estimate some of the indirect cost, which is related to manufacturing overhead, and put it in the total cost estimates? Yes, it's possible. So for that reason, make sure you're generating gross margin. Now, question for you. Did you ever have a situation where you're going to, let's say, Winners? Let's say you're going to Winners. You like something, you buy it from Winners, you pay for it at the cashier, and you going out of the store. Before you close the door of Winners, you went out of the Winners. Let's make it even more dramatic. You went out of the Winners, and you're going to your parking lot to the car, and then you're hearing somebody running after you. And you turn around, and one of the salespeople from the Winners, and say, "Oh, I'm so sorry. I'm so sorry. Can you please come back to the Winners? We forgot something." And you're kind of curious, so you wonder what they forgot. You're going there, and they say, "We sorry, we really sorry about this. When we calculating the price of this product, we forgot to include the security expense for the entire year, which when we allocate it to all the products, we have to charge additional $5. Can you please pay us those $5 now so we can cover our security? Otherwise, we have to take it from the salary from our employees." What you gonna say if this happened to you? Did it ever happen to you? Do you think it ever gonna happen? And if this happened, what you gonna say? It's their loss, correct? Now put yourself in their position. If you forget to include something in your manufacturing overhead, well, it's your loss. Unfortunately, somebody has to pay for it. And in that case, it's not going to be the client. It's going to be you. So that means that estimated total cost for the period is very important. And you as managers and later on as I strongly wish you running your own business, you have to be aware of those things. And you have to know this. If I don't make the client to pay for the cost, I have to pay for it as operating expense. And if there's anything left, now we're going to have income. Otherwise, I can crush one business, another business, third businesses. That's why I usually telling the students for this course is very simple, very logical, and it's interesting and practical at the same time. But there are two ways to get this course. One way is go outside, crush 3 companies. Most likely on the 4th company, you're gonna get it. You're gonna understand what the break-even is. You're gonna understand how many products you need to sell in order to be above the break-even. What is the fixed cost? What is the variable cost? How they behave? And you're gonna get the idea that you need to calculate and come up with the manufacturer overhead, which you want to transfer to the client and get the client to pay. But you have to crush at least 3 companies. And maybe on the 4th company, you're gonna get it. The other option is here in the classroom. Study, play with the numbers, make mistakes, understand why you're making mistakes, understand what if this happened, where is gonna hit me, if that happened, where is gonna hit me, run through the whole possible scenarios of every single business, of every single aspect on all of this calculation, find the answers. Usually you're finding the answers you're learning by making mistakes, and then go on and open successful business. That's how you learn. Either through practice in the real life, either here in the classroom. But you need, in both cases, you need to spend time. It's not going to happen magic. And you have to play with the numbers. Literally play. If I do this, what's going to happen here? If they do this, what's going to happen here? Because as you can see, this is very interactive chart. And what is the final result? Operating income. Well, all of you open the business because you want income. If you want income, you have to know what's going to happen with the if direct material behave as a variable cost. And knowing that direct material behaves as a variable cost. What's going to happen by knowing that direct labor behaves as a variable cost? What's going to happen if I don't apply manufacturing overhead? What's going to happen if I miss one of the costs here? What's going to happen if I put more costs here? All those interesting scenarios. So now, having this in mind, let's keep going with our idea. Now we can sell the coffee. Now we can make a profit. We can generate operating. Great. Now, December 31st comes. Now we have actual number of our manufacturing overhead or the indirect cost. We have the total. Magically, we're going to have the total for the manufacturing overhead that we apply over the period. There's no way not to have it. We have to have it because we're the one who are applying the manufacturing overhead, so we can have that number. Then we're going to have to compare. This manufacturing overhead account is very interesting account. Yes, we put debit and credit, but this manufacturing overhead account is called cumulative account. We're going to run it only and only for the purpose of seeing where the manufacturing overhead is as an actual and as applied. At the end of the period, we're going to accumulate actual applied, compare actual applied, and we're going to close this account because we don't need it. Again, it's not balance sheet account, it's not income statement account, it's just cumulative account for the purpose of calculation manufacturing overhead, which we needed to apply to our product in order to come up with the cost of goods manufactured, which we need to calculate cost of goods sold, which also needs to calculate the gross margin and calculation of the operating income. So the end of the period come, what are the possible scenarios here? The way I see it, and the way probably you see it, there are three possible scenarios. This is the job costing one. Let's go with let's go with this one, will be the job costing only. And then let's go with scenario number one. Let's label it here in brackets one. After that, I'm going to post this for you. You can have it available. Option one, actual manufacturer overhead is $100,000. Applied manufacturer overhead is $100,000. This is the perfect scenario. What that means, whatever we having as an actual cost is actual the cost that we transfer as a manufacturer overhead during the period. Great, awesome, we did a great job. The balance is zero with this account. We don't have to make any adjustments. Great job of the estimation. Whatever we estimated and we apply it as a manufacturer overhead, directly they exactly match our actual manufacturer overhead. Now the question is, how realistic is this scenario? In reality, very unrealistic. Then what's the other possible scenario? And that will be number two. The other possible scenario will be, let's go first. Our actual overhead is $100,000, but we apply $130,000. What's happened in this case? Did we over-apply or under-apply manufacturing overhead? We overestimated, we know over-apply manufacturing overhead, correct? If I over-apply manufacturing overhead, what's happened with my product? Is it overpriced or underpriced? Overpriced. If it's overpriced, where is my cost of goods manufactured? Overstated or understated? Overstated. If my cost of goods manufactured is overstated, where is my cost of goods sold? Overstated or understated? It's overstated. Then where is my gross margin? Overstated or understated now? Understated. Where is my operating income? Understated. Do you see where is the impact of simple mistake of applying more manufacturing overhead? It hits you directly on the operating income. Let's put some numbers so you can feel it. Let's say my sales are, so where's my manufacturer cost of goods sold is 130,000, correct? That's the number that I'm going to use here. Let me play a little bit with those numbers, format this cells. Show me the number with the decimals, with zero, like this. My my operating income, let's put operating income to be 30,000. And my the operating expense is 30,000. So I'm understated with 30,000. What it's gonna give me, what's gonna give me, what's gonna give me. Let's go my operating income. So gross margin is 50,000, which is going to give me my sales 180,000. So I have to work backwards to come up with something meaningful. So my operating income is 20,000. Make sense? This is my situation. when I'm applying, as you can see, I'm applying $130,000. Now, what they have to do at the end of the period, once I see that this manufacturing overhead is over applied, then I'm going to end up with balance, which is on the credit side, 30,000. How can I get rid of this balance? I need to get rid of this balance. I cannot, this account cannot stay with balance. The balance has to be washed out. If I have credit balance, what do we have to do? Currently, my credit balance debt 30,000. How can I get rid of 30,000 credit balance? What should I do with this account? Debit or credit? I have to debit it with 30,000. Now, if I debit this account with 30,000, let's debit it with 30,000. Now that's going to wash out the difference, obviously. Let's format it. This one. That's going to wash out my difference. Let's highlight it in different color. Let's highlight it in red. But I have to apply it somewhere. I have to create some account now. Which account I'm going to create? I'm going to go and credit directly cost of goods sold. If I credit, normally cost of goods sold is on debit side. So if I credit cost of goods sold with the $30,000, what's going to happen with my cost of goods sold? Going to go up or going to go down? Going to go down. So what will be my new cost of goods sold when I apply this $30,000? Let's see. It's going to be equal to this 100,000, 30 minus the 30,000 which I have here. So it's going to be 100. Now what's happened with my gross margin? Went up with 30,000. What's happened with my operating income? Increase with $30,000. Awesome. Now we can celebrate, right? Instead of 20,000, we're actually making 50,000. Awesome. What will be the other possible scenario? Let's go here and check the other possible scenario. That will be job costing 3. The other scenario, obviously, will be the opposite. That we're going to apply, let's say, 100,000 in this case. But my manufacturer, let's go with 130,000. Let's stay with the same scenario. Let's go, we apply 130,000, but my manufacturing overhead, actual manufacturing overhead, is 160,000 in this case. Now, as you can see, I still have $30,000 difference. Correct? What's happened with my manufacturing overhead now? Am I over applying or under applying now? Watch this. My actual cost is 160. I apply 130. Am I over applying or under applying? Under applying. If I'm under applying manufacturing overhead, where is my cost of goods manufactured? Overstated or understated? It's understated. That's transferred to cost of goods sold. Where is my cost of goods sold? Overstated or understated? What's happened with my gross margin? Overstated or understated now? Where is my operating income? Overstated or understated? So do you understand now the logic of all these links? So now, if I have to fix it, what do I have to do? Increase my cost of goods sold, or I have to decrease it? If I already know that my cost of goods sold is understated, what do I have to do it? Increase it. As we can see here, in order to close this balance, I have to add $30,000 now on the credit side. If I add $30,000 on the credit side, I have to debit something. Which account I'm going to debit? We're going to debit directly cost of goods sold. If I debit cost of goods sold, what's going to happen to cost of goods sold? Going to go up or going to go down? Going to go up. So let's make it up. 130 plus this beautiful 30,000, which we forgot to allocate and include it in our estimation. And we didn't apply to our product. Now, boom, what's happened with our operating income? Was directly affected. Oopsie, we thought that we're making $20,000. We just booked the venue for the Christmas party, and then we figured out, oops, the actual cost during the period is actually $160,000. It is not the 130 that we allocated. No Christmas bonus this year. Sorry. Now, the question is, which scenario do you prefer? To be job costing over applied or job costing ratio under applied? Okay, let's think about it. If I'm over applied, if I'm over applying manufacturing, manufacturing overheads, correct? I'm over applying. My cost of good manufacturing is high. Then I'm seeing that I'm making less margin that I want. And since we establish with Amanda that we want 30%, and currently I'm not making that, what I naturally is going to do? Raise the prices. But I'm on competitive business. We're selling coffee, remember? If I increase the sales price, what's going to happen with my customers? The sales going to go down. Now, increase the sales, but don't forget the sales are with direct relationship with the cost. Remember from last chapter? We're chasing contribution margin. Sales increase, variable costs increased. They're catching each other. So that's not going to give me more contribution margin, actually. Do you understand this? Yes, gross margin is different calculation, but increasing sales, that doesn't help me here. I have to go and change my cost structure because now I'm suddenly getting the information that my cost of goods manufactured is higher. So if I want the same profit, I have to increase the sales price. If I increase the sales price in a highly competitive business, my client's going to go to the other store now. Until I find at the end of the period that, oops, I over applied the manufacturer overhead. So what I shouldn't have to increase the prices. Too late, the customer's already gone. So now if you reduce the prices, are they going to come back to you? It's very questionable now, correct? Maybe, hopefully, but so would you, what kind of price you want? The price that always fluctuates or you want stable price? Why? Because you can project, I can budget my cost if the price is stable. If the price constantly going up and down, I cannot budget my cost. I cannot budget my savings. I cannot budget my plan. Should I go on vacation? When to go on vacation? Do you understand this? So now let's go with the other one. There's a very good here in the chat room from Jamali, and he's right, or she. So yes, that's a very right statement about. But let's go over and come up with this conclusion. So we established that over-applied is not good thing. Let's go with the under-applied. What's going to happen if we under-apply the overhead? Suddenly, what we're going to see? Oh, we're making too much gross margin. So, okay, my cost of goods sold actually is not that high. What we naturally going to do? Again, we're in a highly competitive business, and we find out that actually we expecting one cost of goods sold or cost of good manufacture, but that cost of good manufacture now is below what we expected. What we naturally gonna do now? We're gonna reduce the sales price, correct? If I lower the price, imagine I'm lowering the price. My cost of goods sold is understated. Right now, if the price stays the same, I'm losing 10,000. If I lower the price further, I'm gonna lose even way more than $10,000. By the time you realize, it's gonna be too late. You can run a business on a loss for the long period of time. And if you don't do this calculation on the regular basis, by the time you figure out that you're not losing 10,000, you're losing now more than $10,000. By the time you figure out how much you're losing, you may lose your business. You're gonna run out of cash and now bye-bye. That's how sensitive managerial accounting is. If you make a mistake and if you don't calculate something properly, yes, you're gonna find out about it, but you're gonna find it on the hard way, which directly transfer closing the business. That's why don't be surprised, and I want you to start monitoring the businesses. If you want to run a profitable business, have this in mind, learn from managerial accounting, and at the same time monitoring the other businesses. Go to any business, I told you, make a simple thing. Go in the business and start thinking, which of this, when you go to the store or go to the wherever you go, doesn't matter what kind of store, start thinking, what's the variable cost, what's the fixed cost? If I'm manager, how can I save on this, which cost I can save, which one I can increase, how can I utilize more of this cost? What will be now when you're adding the cost of goods sold and you're understanding what's direct material, direct labor manufacturing over here, you can easily say, okay, when I see the product, what will be the direct material here? What will be the direct labor here? What will be the manufacturing over here? Make sense? Florence, I'm going to answer this question just in a second. And once you know all those pictures, I want to start monitoring the business. When the new business open, start monitoring. You see how many months this business is going to last. You can easily do a simple uh, analysis if you want on monitoring. Choose one street anywhere in Vancouver where they have like a different type of stores. Take a picture of the stores. After 3 months, go there and take another picture and start making comparison and try to find the differences. And you'll be surprised that you may find 2 or 3 businesses which were there 3 months ago, now they're gone. And there's new businesses coming. Then take another picture another 3 months later and see what's happened. You're in Douglas College for 4 months. Every semester is 4 months. On the way to the Douglas College, choose some street, some area which have different businesses. Make a picture, and at the end of the semester, check again and see if there's any differences. And then ask yourself, why this happened? Maybe because somebody didn't calculate manufacturing overhead correctly. Maybe because somebody didn't know that they need to be on the break even in order to make a profit. Maybe because they didn't know that there's a contribution margin per product and they should focus only on the products which give them the highest contribution margin. Maybe they didn't know that how much sales they need to generate and how many products they need to sell in order to stay in the business. Maybe they're not utilizing effectively fixed cost and paying too much on the fixed cost, which they're not utilizing it. So basically, they're losing on that one. There's so many possible scenarios, but this is over-applying, under-applying manufacturing overhead. It might be one of them. They're selling product which is overpriced. There's no customers inside. Or maybe because they're simply selling products which nobody wants to buy. Why? Because they just opened the business on the wrong place at the wrong time. So, having this in mind, now we know what's over-apply, under-apply means to us and how to fix the problem. This is your job costing, people. So now the question is, how often do we need to review the estimated cost, this calculation? Technically, how often we have to calculate predetermined manufacturing overhead? That should be the right question, because that's what I see as a end of the line of this question. Predetermined manufacturing overhead, Amanda, that's a great guess, has to be calculated every period. Now, the period, it has to be a long period. It has to be minimum 1 year. So every year, yes, you have to go back to the drawing table, start calculation, estimation of the total cost for the period, usually 1 year, estimate usage of allocation base, which you choose to allocate manufacturing overhead. Again, 1 year, come up with the predetermined overhead for the next year. Don't change it until the entire year expires, because if you start changing it during the period, you won't be able to compare the cost of the products. If you find out that you made a mistake, live with it, adjust, and keep going until the end of the period. Then make another estimation and keep going, keep going, keep going. How accurate will be an estimation? The only time is going to tell you. So you have to be proactive, keep going and keep going and keep going with the estimation. It doesn't matter how accurate. The usual mistake is between, if you can achieve mistake between 5 and 10% of the actual, you would say that you are a great estimator. How the new business started with the estimate? Well, the new business first, like, as we can see, some of those costs, it can be, you will know about those costs, or you're going to have some ideas even before you start the business, because you know how much security you have to pay, you know how much insurance is going to pay, you know approximately how much utilities you have to pay. Rent, you're going to have a contract which is a fixed contract for the period of time. Taxes, you can easily estimate it. If the other thing that you can do is Statistic Canada. From the Statistic Canada, see the similar business, chase the size of the business, and come up with the estimations. Now, projection, they're always going to run projections based on this depends on the business. Estimate if it's a coffee shop, how many tables sitting will have, what's the traffic of the people, and do some estimation. Right? You can you can do your best. Once the first year is gone, then you're going to have more data and then start applying that data and come up with the manufacturing overhead, which actually is going to catch all the cost. Again, don't forget, if you don't include the cost here, you're not going to transfer that cost to the client. Client not going to pay, and you have to pay for it in your pocket. But if you're a smart business and you're including in your manufacturing overhead monthly free coffee for the client, make the client pay for it, and every month you can give the clients one free coffee. So what that means, every time when you see somebody offer you something for free, you should ask yourself a question. Is it actually free? And how many times I already paid for that? And make sure you get at least 2 of those free stuff, because most likely you already paid for it. The free sample food in Costco is not free, my dear students. It's already incorporated in the manufacturing overhead, which is applied to the cost of every product. It may look like a free, but it's not free. I want you to think about it these days. And that's you as a business. If you want to be successful business, you always have to provide something free. Customers like free things. Where you have to put it in the price, in the cost of the manufacturing overhead. And then give it to them for free. Make sense? So now let's see this entire picture for the business and the job costing from the perspective of the slides. Remember when we were on the slides? We're on the slides of the direct material, direct labor, manufacturing overhead. Manufacturing overhead. So now we have to start preparing this cost job sheet or job cost sheet. On which cost sheet we're going to have direct material, direct labor, manufacturing overhead. Once I have those three, I can say I have a total cost for my product. Then I can calculate the unit product cost, and then I can calculate, then we're going to come to the point, how much markup you want on your product. So let's go one after another. Direct material. Direct material, easily, we're going to go to the warehouse, we're going to ask somebody, we're going to get it, we're going to get the material, we're going to see the cost per unit, boom, 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 we get the cost for the direct material, that's easy. Direct labor, we're going to have the person working from this time to that time. We're charging, that's total 8 hours. We're going to give him $11. Not a good example because in BC now it's illegal, but let's pretend it's okay. It's not in BC, somewhere other country, we pay $11. That's total $88. We get the direct labor. The point is we to get the direct labor. We got a direct labor. I have it. Make sense? So once I have this, then I can move to the next one. Apply direct labor in my cost sheet. Then coming the most challenging thing, manufacturing overhead. What will be the manufacturing overhead? How can I come up with this manufacturing overhead? Because if I don't come up with the manufacturing overhead, I don't have the three components of my product, direct material, direct labor, manufacturing overhead. I need that manufacturing overhead. How can I get it? First, I need the allocation base. On a location base, such as direct labor hour or direct labor door hour or machine hours, is used generally for the manufacturing overhead of the individual job. And we use that allocation base because otherwise we cannot allocate the overhead. Manufacturing overhead has so many items which coming from different points. Many types of those manufacturing overhead costs are fixed. We have a portion of the variable, and the timing of the payment of manufacturing overhead is different and varies for different costs. For that reason, we need to come up with the total estimated cost for the period. Then we're going to get the allocation base. We're going to estimate the total usage of the allocation base for the same period, usually future period, 1 year from now, and 1 year from now that we're going for the further in the future. And that's going to give us our predetermined manufacturing overhead rate. Now I can start applying manufacturing overhead. Why do we need it? Obviously, predetermined overhead, because when we use it, I can start applying manufacturing overhead. Then I can get the job cost of the job. Otherwise, I'm never going to get it. Actual overhead for the period is not known until the end of the period. So I need that predetermined overhead to apply the cost to everything that I'm going to have over the next period in the beginning of the period. Predetermined rate is based on the estimation. Keep that in mind. And predetermined overhead rate is computed before the period starts. And it's used for the entire period. You're not changing it in the middle of the period. So now how are we going to apply it? Well, we have the rate, which is predetermined based on the estimation. We're going to see the actual usage of the allocation base, which we're using as a denominator to get the predetermined overhead, and we're going to apply the overhead. So this company, they estimated in our example here, they estimated that the total cost for the upcoming period is $640,000. Total for the allocation base, they choose the direct labor hour, as you can see, and they come up that the direct labor hour is going to be 160,000 hours for the upcoming period. That gives us $4. It's coming to a very complex calculation, 64 divided by 16, or how many times we have 16 in the 16 4. That will be 4 times. That means $4. That is our direct labor. Manufacturing overhead, predetermined overhead based on the direct labor hour. So every time when worker work 1 hour, we have to allocate $4 to our product. In this case, the worker worked 8 hours. Times $4, that's going to give $32. Now I can calculate the total cost. And since I have 2 units which are completed, I can come up the unit per cost. What if the client, once he sees this and say, can I have 1 more unit and how much will be the cost? Can we say to the client, oh, it's going to be $118? Can I say that to the client? Or I have to run the calculation again? What do you think? Again, because now if I add 1 additional unit here, that's not going to be the unit product cost. That will be the cost if I'm running process costing. But since I'm at the job costing, you have to run the calculation again. And yes, you're right. So let's go with this again. If the average cost should be interpreted as a cost would actually be incurred if 1 additional unit is produced. No, it's not. Why? Because most likely some of the cost we're dealing with the fixed cost, and most likely the price will be different. It's going to be less, it's going to be more. We have to do the calculation, find out what is it. Which brings us to the point that allocation base is very important. Why? Because allocation base is used for the predetermined overhead calculation. And then the cost driver is a factor of the cost of the overhead. So whatever we choose of the allocation base has to be actual the driver for the cost for our overhead. And if we're choosing the wrong allocation base, we may have a product which don't have manufacturing overhead. And then we're gonna have inaccurate calculation for the product cost. For that reason, the common allocation base is used as a direct labor, or direct labor is used as a common allocation base. Now let's see this before you jump on the calculation for this particular question. Let's read first the question, check the possible answers, and logically to come up with the right answer without touching calculator. Can we do that? Or do you want me to do that? No calculator, nothing. Just read the question and going over the answers one after another. Do you want me to show you or no? Okay, let's go. Pretend I don't have calculator and I'm lazy. I don't want to calculate. First, this job require 200 of direct material, 10 direct labor hours at $15 per hour. Estimated total overhead for the year was 760, and the estimated labor hours are 20,000. What will be the recorded as a cost of the job? First thing first, we're chasing product cost, correct? The question asks, what will be the product cost for this job? What's included in the product cost? Direct material, direct labor, manufacturing overhead, correct? Exactly, Gina. Now, what is my direct material only? How much my $200? So in that case, is it possible answer A to be my answer? Option A to be my answer? No. Okay, A is gone. How much is my direct labor? $15 per hour. How many hours? 10 hours. So that's bringing 150. That means if I add direct material plus direct labor, how much is it? 350. Is that my product cost? No. So is it possible B to be my answer? No. So A, B is gone. Now we on the C and D. Let's think about it. I have $350 for direct material, direct labor. If my total estimated direct cost is 760,000 and direct labor hours are 20,000, and that's going to give you predetermined overhead, which I have to apply time direct labor hours, which are 10. Is it possible that calculation to increase the total cost, which I already have direct material, direct labor 350, with only $30? No. So what will be the logical answer without touching calculator? D. Make sense? So one way to get this type of question is go and calculate and get the right answer and move on. The other option is think logically, eliminate the wrong answers, and obviously you're going to come up to the right answer. Which approach you're going to use, it's up to you. I'm just showing you another way you to solve the multiple choice questions without touching calculators. I need you to become smart. Smart means to have the knowledge and to know how to use it. Do you understand this? Having only the knowledge, it's useless. Knowing how to use it to solve the problem, that's what makes difference. So calculation, obviously, if you have to go manufacture overhead, it's going to get 38. So the $380, answer C, is actually the cost of the manufacturing overhead, which is not our total cost is 730. Now, what's the flow of the document if we have to run this job order costing system? Everything starts again from the sales order. Everything starts with the sales order. Sales order is prepared on the basis of issuing that sales order. Once I have the sales order, then I can start production order. On production order, I'm going to make a requisition for the material. I'm going to issue the direct labor time ticket, and I'm going to apply the predetermined manufacturing overhead. Remember, predetermined manufacturing overhead is calculated before the start of the period and is applied based on the allocation base. And then I'm going to prepare this job cost sheet, which is going to give me the cost for my project. Now let's see the detail flow of the cost by using the T accounts, which we already saw in the Excel spreadsheet, but this is another application here. First, direct material. Direct material, but in order to apply the direct material, we have to purchase direct material. Once I purchase direct material, then I can use it. How can I use it? As a direct material, which directly is going to go to the work in process account, and as an indirect material, which is going to go to the in manufacturing overhead account on the debit side, which will be my actual cost. I'll start calculating now the actual cost for the manufacturing overhead. First, again, we're going to purchase the raw material, debit raw material, create accounts payable, and then we're going to start using the raw material by debiting work in process, debiting manufacturing overhead, and creating the raw material inventory to show that we actually use that inventory. Next thing, direct labor. From where am I going to get direct labor? From salary, wages, payroll. What else? What kind of labor am I going to get from there? Indirect labor. Direct labor, as you can see, goes directly to work in process, where the indirect goes to the manufacturing overhead. Generally, debit work in process, debit manufacturing overhead, credit salary, payroll. Now I have to add manufacturing overhead on the debit side, which will be anything else. So what we're going to use, debit manufacturing overhead, and going to have accounts payable for the utilities, property taxes for the taxes, prepaid insurance for the insurance, depreciation for any depreciation expense. Once I do that, then I'm going to apply that manufacturing overhead using the predetermined manufacturing overhead and the actual usage of the allocation base. So what I'm going to do, debit work in process inventory and credit manufacturing overhead. After that, I'm going to start comparing manufacturing overhead. Where is my actual and how much I applied? Actual costs come from the period on the debit side. Applied goes from the credit side over the period when I'm applying directly to as a manufacturing overhead to come up with the cost of the product. What we're going to do with the non-manufacturing costs, those manufacturing costs will be directly expense. Salary expenses, expense. Advertising expenses, expense. Go. Again, salary expenses, advertising, go. Once I have direct material, direct labor, manufacturing overhead, I can say I have a product. If I have a product, that product comes with the cost. Since I'm manufacturing it, that will be cost of the goods manufactured. And once product is ready, I'm going to flip it from the work in process account to the finished goods inventory account at the cost which I manufactured. So debit finished goods, credit work in process for the finished goods which are manufactured at the cost of good manufactured. And it's going to stay in the finished goods until I actually sell it. Once I sell it, I'm going to have cost of goods sold on the debit side, reduce the inventory on the credit side. But then I'm selling it. So I have to show credit my sales and debit either cash, either accounts receivables. So debit accounts receivables, credit sales for the sales. And since I'm selling product, now I have to write off the product or move it out my inventory, show that those products are not longer in my inventory, but I'm going to debit cost of goods sold. Sales and cost of goods sold, they're going to meet each other in the income statement, and that's going to give me the gross margin. At the end of the period, what I have to do, I have to go back to the manufacturing overhead account, which I opened in the beginning of the period. On the debit side, I'm going to see how much is the actual. On the credit side, I'm going to see how much is the applied. And I'm chasing what will be the possible scenarios. First scenario is I might have over-applied overhead. What that means, the amount of the overhead applied to the job is, for the under-applied overhead, is less than the actual cost for the period. Or I may have over-applied overhead, which is now the amount of the overhead that I'm applying using the predetermined overhead rate and the allocation base is more than the actual cost for the period. Okay, fine. Let's see what this company doing. The actual overhead for the year was $650,000. Now, the total hours that they're working, 170. We applying predetermined overhead $4 per direct labor hours. So how much we applied based on the direct labor hours actually used, and $4 predetermined overhead. Looks like we applied $680,000. Are we over applied or under applied? How much over applied? $30,000. Okay, yes, that's exactly what's happened. We have over applied $30,000. What are we going to do with the $30,000? Now, one option is directly the one that they show. It directly goes to the cost of goods sold and adjusting cost of goods sold. The other option is we're seeing where the $680,000, which we applied, goes. There's 680, where they're going. And we're chasing how much of those 680 are in work in process, how much in the finished goods, how much is the cost of goods sold. And we proportionally apply the $30,000 for all those three accounts. Let's see direct application. Direct application is we're going to debit since we over applied, we have to reduce the cost of goods sold. So we're going to debit the overhead, we're going to create cost of goods sold, and we reduce the cost of goods sold with $30,000. The other option is we to prorate it. How are we going to prorate it? I'm going to copy this and I'm going to move to the Excel spreadsheet. And I'm going to show you. Probably already have idea how I'm going to do that, but let me show you regardless. Okay, that's not going to give me. I know this yesterday I had the same problem with the other section, so I have to be creative here. For that reason, I'm gonna use the snapping tool. It's easy when you have so many tools available. I'm gonna get this one, so now I can copy it and flip it to Excel spreadsheet. Like this, and now I have to manually actually enter it, which will be work in process account I have finished goods account, and I have cost of goods sold. And I have total. And as you can see, let me format those one. I'm gonna format it as a number for now with no decimals like this. I have those three accounts and the work in process 68,000. Finished goods are 204,000. And cost of goods sold 408,000. Do I share my screen? Yes, I do share my screen. Usually I forgot to share my screen. So as you can see, the total is equal to the manufacturing overhead that we applied over the period. Now, the next thing that we're going to see is, let's express this as a percentage. How much is the total cost? Obviously, the total cost is going to be total divided by total. That's going to be 1, or as a percentage, 100%. Now let's start expressing every each of those as a total. So the 68 divided by 680 is going to be percentage 10%. The next one is going to be this one divided by, sorry, the divided. It's going to be 30%, and obviously for the last one left to be 60%. But first I have to format the cells and then put 60%. So I have the percentage. Now the question is, what do I have to do? I have to reduce this amount to go down to 650, because that's how much is the actual. So in order, I have to reduce it with 30,000. The question is, if the 30,000 is the total that I have to reduce to come up with the 650, how much will be a reduction in the work in process, finished goods, and the cost of goods sold using the proportional rate, knowing that the 30,000 is 100%. Well, I'm just proportionally going to use it. 30,000 times 10%, and I'm going to log this the 30,000, and I'm going to just drag it down and get those percentages, which the total is going to give me 30,000 when I calculate it. And then I simply is going to apply those one to my calculation here, and I'm going to see how much should be the new after reduce those accounts, how much will be new balance for every each of those accounts, which is going to give me 650. That's your proportional allocation of the cost to all those three accounts. Don't forget, the total has to be the manufacturer overhead applied. Then you see what's the difference between the actual and bring the applied to the actual. Let's go to the slides and finish those slides. So again, once we get this, we're going to get the proportional method. We're going to see how much we need to allocate of those 30,000 each account. And we're going to start reducing those accounts. Work in process with 3,000, finished goods with 9,000, and cost of goods sold with 18,000. And we're going to reduce manufacturing overhead from the debit side with 30,000 to bring it to 0. Let's see one question here. This company has actual manufacturing overhead of $1,210,000. And predetermined overhead was $4 per machine hours. The company worked 290,000 machine hours during the period. What's the manufacturing overhead is? So How much is 4 times 290? Is it more than actual or less than actual? How much less? 50,000. So if what we are applying is less than the actual, are we over applying or under applying? So what will be the correct answer? Amanda, do you see it as a B? Excellent. So the amount will be B in this case. So again, yes, one will be always actual, the other one will be applied. Once you see the predetermined overhead, once the information is given to the predetermined overhead and the actual hours work, that's how you're getting the applied. Actual is actual. Then comparing the applied versus actual. If the actual is more than what you're applying, you're under applying. If the applied is more than the actual, you over apply. That's how you should. Uh, so again, here, applied overhead is less than the actual, under applied. Applied overhead is more than the actual, over applied. Alternative one is to increase the cost of goods sold to catch up with whatever we're missing on the actual cost, or to decrease cost of goods sold to reduce it to the actual cost. Or work with all the three accounts and here the same three accounts. Now, careful with this question. What effect will have adjustment in cost of goods sold for the over-applied overhead on the company net operating income? Do you want we to do this analysis together for this question? Okay, let's copy the question. Let me see if you allow me to copy it and move somewhere. I'm gonna go and move to the scenario, which is, I need some calculation here quickly, and I'm gonna flip it here. I'm gonna share my screen. I know I'm not sharing my screen right now, and I'm gonna share it right away with you so you can see it. Here we go. That's my scenario now. So now let's see where the question is. I want to push it here. What effect will have adjustment on the cost of goods sold? So we have to adjust this amount. We don't know how we have to adjust it. So currently, let's pretend we're here. Overhead cost. What effect will have adjustment on the cost of or the over applied overhead? So my overhead is over applied, correct? That's exactly the scenario that we're talking about here, over applied. So currently, my cost of goods sold is 130, the one that I'm applying, correct? Now I have to adjust it because I'm over applying the overhead. What will be the effect on my operating income? So what they have to do with the cost of goods sold, increase it or decrease it? So think about first, I'm over applying the manufacturing overhead, correct? If I'm over applying manufacturing overhead, where is my cost of good manufacturing? Over apply or under apply? Again, I'm over applying manufacturing overhead. Where is my cost of good manufacturing? Overstated or understated? Yes, you're saying something here. Overstated. Cost of goods sold, overstated or understated? Overstated. If I adjusted overstated cost, what will be effect on my operating income? It's going to go up or it's going to go down? So watch this. So let's go again. Manufacturing overhead is overapplied. We establish cost of good manufacturing are overstated. Cost of goods sold are overstated. If I adjust it, where is my operating income right now? If my cost of goods sold are overstated, where is my operating income? Should be understated, correct? Because cost of goods sold is minus of something. Are you guys with me? Can you guys hear me? So if my cost of goods sold is overstated, where's my operating income? It's understated, right? If I have to adjust it to catch the actual cost, what's going to happen with my operating income? Let's see if I have to adjust it. So 130 is now, but it's overstated, so I have to adjust it with the actual to bring it to the actual. What's happened with the operating income? Going up or going down? Going up. So what will be the logical answer here? A. Everybody see it as a A? Do you understand why is A now? Okay, great. Let's go to the slides. And yes, the answer will be A in this case. Net operating income will increase. So let's wrap it up here for the summary with the overhead. Overhead. We need to predetermine overhead rate. How are we going to get it? We're going to estimate the total operating cost for the period. We're going to divide it by the estimated total allocation base usage, and we're going to come up with the predetermined overhead rate. Now, every time during the period, every time when we're using the actual allocation base, we're going to apply the predetermined overhead rate, and we're going to have the total manufacturing overhead applied. At the end of the period, we're going to compare the actual total manufacturing overhead and the total manufacturing overhead applied. And we're going to see, is it over-applied or under-applied? If the actual is more than the applied, obviously we will under-applied. If the actual is less than applied, we'll be over-applied. If it's over-applied, we're going to adjust all this. If it's under-applied, again, we're going to adjust. Another picture here to show you the cost flow, the one that we saw again with the T accounts. We're going to get when we purchase the raw material, we're going to debit it. When we use it, we're going to create for the direct material, which is going to go to the work in process as a debit. And we're going to create it to go to the manufacturing overhead as a debit. Now we have the first element in our product, which is direct material. Let's get the second element, which is the direct labor. From which account we're going to get it? Probably from the salary or wages payable. Credit that account, debit working process for direct labor, and debit manufacturing overhead for the indirect labor. Then, in the working process, we have to meet the three costs: direct material, direct labor, manufacturing overhead. Direct material, direct labor, we already have it. Now we have to, from the manufacturing overhead, we have to use the predetermined overhead rate times the actual usage of allocation base, and we're going to apply the manufacturing overhead. Once we apply the manufacturing overhead, we can move the finished products with their cost, which will be cost of goods manufactured, into the finished goods. They're going to stay in the finished goods until they stay in our warehouse. Once they're sold, we're going to reduce the finished goods by crediting and debit cost of goods sold. At the end of the period, we're going to go to our manufacturing overhead account and we're going to see are we over-applied or under-applied. And then we're going to adjust to bring this account to zero by either adding more cost of goods sold or deducting cost of goods sold. Adding more cost deduct sold is going to reduce our operating. Deducting cost of goods sold is going to increase the operating. What we're going to do if we're having multiple predetermined overhead rates? Well, that will be a challenge. Large company usually using the multiple predetermined overhead rates. That will be more complex and we need more accurate. In the technology world, we have, in order to transfer the information and use it for our managerial purposes, we try to find language or format which is close and convertible to Excel. As you can see, once you're converted to Excel, then it's easy for me to use the information, make the calculation, see the differences, and make an analysis. And that concludes today's chapter. As you can see, this predetermined overhead rate, again, using estimations. If we make small mistake on the estimation, that's going to change my predetermined overhead rate. But even small mistake on the allocation base will be more powerful because the allocation base is my denominator. So that's the tricky part here. This allocation base. Because as you can see, denominator has more power than the numerator. And that directly reflect the predetermined overhead rate. And that directly affect the manufacturing overhead applied. If we estimate less hours, but we actually use now if I estimate less hours, my predetermined overhead will be high. But if I use more hours, I'm gonna over-apply. The opposite. If I estimate more hours for direct labor, my predetermined overhead is gonna be low. But if I use less hours over the actual hours, then my apply overhead will be under-applied. And next time we're gonna see another way to allocate manufacturing overhead without using the predetermined overhead rate. And we're going to see ways the flow of the predetermined overhead rate. The only thing that they have to tell you is, unfortunately, in the accounting standards recognize only traditional costing or this predetermined overhead rate for the manufacturing overhead. That's the only one we recognize. the method that we're going to see next class is not recognized by the accounting standards. So that's all for me, guys.